Minority mindset just exposed the 600% wealth cycle. But here on the pavement, it does not look like an investment boom. It looks like a sovereign debt trap. Because when a government is buried under almost $39 trillion of debt, when inflation refuses to die, when the Fed cannot cut rates without weakening the dollar, and when global buyers are no longer enough to absorb the debt, the system needs a new story. Not gold, not oil, not a balanced budget, a new digital story. Bitcoin, crypto reserves, tokenized assets, stablecoin, tips, gold, hard assets. A new wealth cycle built around the idea that cash holders are about to be punished, while asset holders ride the reset. Jaspreet and minority mindset are explaining the opportunity. Broken economy is asking the darker question: who becomes the exit liquidity? Because when the system tells ordinary people to rotate out of cash and into volatile assets, at the exact moment debt pressure is exploding, you need to slow down. This may be a real opportunity, but it may also be a transfer mechanism. Cash savers get diluted, bondholders get squeezed, workers get pushed into risk, 401k holders get pulled into the market, crypto believers get told they are early, and Wall Street gets another cycle of liquidity. That is the trap. This is not just about Bitcoin going up. This is about the dollar searching for a new anchor. And if that anchor becomes a volatile digital asset narrative, ordinary people need to understand the risk before they become the fuel. Welcome back to Broken Economy. Today, we are decoding the crypto-backed dollar trap, not because Bitcoin is fake, not because hard assets are useless, not because inflation hedges do not matter. They do. But because every time the system enters a debt crisis, the middle class is told to run somewhere. Run from cash. Run from bonds. Run from inflation. Run into risk assets. Run into crypto. Run into gold. Run into whatever narrative is moving fastest. And when ordinary people run late, they often become liquidity for the people who entered early. That is the danger. Let's start with the Fed. Kevin Warsh is walking into a brutal policy trap. The market wanted rate cuts. Trump wants lower rates. Borrowers want lower rates. Real estate wants lower rates. Stock investors want lower rates. The government wants cheaper debt. But inflation is not cooperating. Oil, energy, tariffs, food, logistics, and sticky services, inflation, make it extremely difficult for the Fed to cut aggressively without risking another inflation wave. That is why the June 17 meeting matters. A few weeks ago, many investors were still dreaming about cheap money. Now the market is increasingly accepting that the Fed may hold the line. No easy cut, no quick rescue, no free liquidity. That changes the entire wealth cycle. Because if rates stay high, cash looks safer on paper. But if inflation remains higher than the real return on cash, cash still loses purchasing power. That is the cash trap. You think you are safe because your bank account balance does not move, but the world around the balance is repricing. Groceries move, rent moves, insurance moves, gas moves, healthcare moves, gold moves, Bitcoin moves, stocks move, real estate moves. Your cash sits still, and sitting still in an inflationary world is not safety, it is slow liquidation. That is why minority mindset is pointing to the next wealth cycle. The argument is simple. If the government keeps running deficits, if money keeps being debased, and if political pressure pushes toward easier money later, then assets may run much harder than cash. Bitcoin can run, gold can run, tips can protect purchasing power, hard assets can become the new safety trade. That logic is not crazy, but the timing is dangerous. Because when a narrative becomes obvious, the late buyer carries the volatility. Bitcoin can protect some people, but it can also liquidate people who buy with panic and sell with fear. Gold can preserve purchasing power, but it does not produce cash flow. Tips can hedge inflation, but they are still bonds with real rate risk. Crypto can become a hedge, but it can also become a high beta risk asset that crashes when liquidity disappears. That is why this video is not telling you what to buy. It is telling you what to understand. Understand the game before the game uses you. Now let's talk about the crypto-backed dollar idea. There is no official system where the US dollar is formally backed by Bitcoin. That is not the current reality, but the narrative is growing. Strategic Bitcoin reserves, crypto-friendly policy, stablecoins backed by Treasury bills, tokenized real-world assets, Bitcoin as digital gold, crypto as a way to absorb global capital, digital assets as part of the new financial architecture. That is the direction some policy circles and investors are pushing, and the reason is obvious. The old anchors are under stress. Gold is politically inconvenient. Oil is geopolitically unstable. Treasury buyers are not infinite. The debt is too large. The deficit is too large. The interest bill is too large. So the system looks for new demand. Stablecoins can create demand for treasury bills. Bitcoin reserves can create a new confidence narrative. Crypto markets can attract global retail liquidity. Tokenization can make financial assets easier to distribute. And all of this can be sold as innovation. But innovation can also become refinancing. That is the part ordinary people need to watch. If a debt system cannot find enough traditional buyers, it will search for new channels. Banks, pensions, stablecoin users, crypto ETFs, retail investors, foreign apps, global wallets. The system does not care where the liquidity comes from. It only cares that the liquidity arrives. That is why the crypto dollar story matters. It is not just about decentralization. It is about who supplies liquidity to the debt machine. Now look at stablecoins. Many dollar stablecoins are backed by cash, bank deposits, short-term treasuries, or similar safe assets. That means, when stablecoins grow, demand for short-term US debt can grow too. On the surface, this is useful. Stablecoins can improve payments. They can give people faster dollar access. They can reduce friction. They can help global dollar usage. But structurally, they can also turn millions of users into indirect supporters of treasury demand. You hold a digital dollar. The issuer holds T-bills. Your app feels like cash. But underneath, the system is still tied to US debt. That is not automatically bad, but it is not neutral. It means the digital dollar future may also be a debt distribution machine. Now bring Bitcoin into the story. Bitcoin is different from stablecoins. It is not a treasury-backed dollar. It is volatile. It has a fixed supply schedule. It trades like digital scarcity. Supporters see it as an escape from fiat debasement. Critics see it as speculation. Both sides have arguments. The important point is this: if the government or major institutions begin using Bitcoin narratives to support confidence in a new monetary cycle, Bitcoin may become part of the political story, not just the cypherpunk story. That changes the risk. When Bitcoin was mostly an outsider asset, the story was escape. When institutions adopt it, the story becomes integration. And integration can bring liquidity, but it can also bring surveillance, regulation, taxation, leverage, ETFs, and Wall Street control. That is the trade-off. The more Bitcoin enters the official system, the less pure the escape narrative becomes. Now let's talk about the cash saver. The cash saver is the quiet victim in this cycle. This is the person who does not want to speculate. They do not want leverage. They do not want crypto. They do not want options. They do not want to chase stocks. They just want to preserve what they earned. But if inflation runs above their after-tax return, they lose. Slowly, legally, quietly. That is the hidden tax. And when people realize cash is losing, they are pushed into risk. That is the psychological trick. The system does not have to force you to buy assets. It just makes sitting still painful. Then you move, maybe into stocks, maybe into crypto, maybe into gold, maybe into tips, maybe into real estate, maybe into whatever the current cycle is selling. That is how inflation turns savers into investors, and sometimes investors into exit liquidity. This is where tips enter. Treasury inflation-protected securities are designed to adjust principal with inflation. Funds like SCHP give exposure to inflation-protected treasuries. They can make sense as part of an inflation defense framework, but they are not magic. They can still fluctuate. They can be affected by real yields. They can underperform in certain environments. They can protect against some inflation dynamics, but not every personal cost shock. If your insurance doubles, your rent jumps, and your grocery basket changes, your personal inflation may not match the official index. That is the problem. A hedge against CPI is not always a hedge against your life. Now gold. Gold is the old confidence asset. No counterparty, no earnings call, no software update, no CEO, no central bank promise. It is not perfect. It does not pay dividends. It can be volatile. It can lag for years. But when faith in paper weakens, gold returns to the conversation. That is why central banks buy it. That is why savers hold it. That is why it survives every monetary regime. Gold is not about getting rich quickly. It is about distrust. When people distrust the system, gold becomes a language. Now, hard assets. This is where the real money rotation becomes important. In a debt crisis, money often rotates toward things that cannot be printed. Energy, metals, land, water, infrastructure, nuclear, food systems, productive businesses, physical assets. The reason is simple. You can print claims. You can print debt. You can print tokens. You can print dashboards. But you cannot print copper overnight. You cannot print uranium overnight. You cannot print farmland overnight. You cannot print grid capacity overnight. You cannot print real skilled labor overnight. This is why broken economy keeps coming back to physical reality. I is digital. Crypto is digital. Stocks are digital claims. But the world still runs on energy, materials, water, food, logistics, and labor. When monetary trust weakens, physical bottlenecks become more important. That does not mean every commodity trade wins, but it means the next cycle may reward people who understand real constraints. Now, what is the danger of the 600% wealth cycle narrative? The danger is FOMO. The number is designed to move emotion. 600%. It makes cash feel stupid. It makes patience feel dangerous. It makes people want to act immediately. But the market punishes emotional entries. If you buy because you are afraid of missing the cycle, you are no longer investing. You are reacting. That is how exit liquidity is created. The early buyer sells vision. The late buyer buys panic. The influencer sells urgency. The platform sells access. The asset manager sells the product. And the ordinary worker buys at the moment the story feels most obvious. That is the risk. Again, the assets may be real. Bitcoin may rise. Gold may rise. Tips may protect. Hard assets may outperform. But if you enter without a plan, the cycle can still eat you. The asset is not the strategy. The plan is the strategy. Now bring this back to the pavement. Imagine someone driving after work to earn extra cash. They have maybe $10,000 saved. They are afraid of inflation. They are afraid of missing Bitcoin. They are afraid cash is dying. They are afraid the Fed will cut later and assets will explode. They are afraid if they do nothing, they lose. That fear is powerful. And that fear is exactly what markets monetize. So the question is not, should you hold cash or crypto? The question is, what risk can you survive? Can you survive a 40% crypto drawdown? Can you survive gold going sideways? Can you survive tips volatility? Can you survive cash losing slowly? Can you survive a job loss? Can you survive a car repair? Can you survive without selling at the worst moment? Because if you cannot survive the volatility, the asset may be right and still ruin you. That is the brutal truth. Now what should ordinary people watch? Watch the June Fed meeting. Watch whether Warsh holds rates. Watch CPI and PCE. Watch oil. Watch Treasury yields. Watch stablecoin regulation. Watch strategic Bitcoin reserve proposals. Watch ETF inflows. Watch gold. Watch TIPS real yields. Watch whether the dollar weakens. Watch whether 401k flows chase the asset cycle. Watch whether retail becomes euphoric. Watch whether Wall Street packages the new story into products. Because once Wall Street packages something, the retail flood can begin. And once retail floods in, early money may begin looking for exits. That is the cycle. So, what is the broken economy conclusion? Do not be passive, but do not be manipulated. Cash has risk. Bonds have risk. Crypto has risk. Gold has risk. Hard assets have risk. The dollar has risk. The real question is not, what is safe? The real question is, what combination of risks can I survive? That is how adults think in a broken economy. Jaspreet is right to warn that wealth moves in cycles. But broken economy is warning that cycles do not enrich everyone. Cycles enrich the prepared. Cycles punish the late. Cycles transfer wealth from emotional hands to patient hands. And if the government, Wall Street, and crypto markets converge around a new digital dollar narrative, ordinary people must understand the plumbing before they become the liquidity. Go to the comments and tell us what you think. Would you trust a dollar system that leans on Bitcoin, stablecoins, and tokenized assets to restore confidence? Are you holding cash, Bitcoin, gold, tips, hard assets, or waiting on the sidelines? Do you think the 600% wealth cycle is a real opportunity? Or is it the final exit liquidity trap for ordinary workers? And if you only had $10,000 saved, would you protect it, risk it, or split it? Minority Mindset explained the wealth cycle. Broken economy is showing the street level risk, because when the debt machine needs new buyers, it does not care whether the money comes from Wall Street or your paycheck. Subscribe to Broken Economy for more clear breakdowns of finance, technology, markets, labor, and the real economy behind everyday life. Stay awake. The new dollar story may be digital, but the bill will still land in your wallet.